So you're welcome to part 2 of bank reconciliation statement, and in this section or in this tutorial we are looking at reasons why the bank reconciliation statement, right, and the cash book balance may disagree, and we progress to look about other aspects like bank overdraft and preparation of bank reconciliation statements and other things that we'll be looking out for in the bank reconciliation statement. All right, so here in the previous video we said that there are times that where if the bank statement is issued to the current account holder, that's the customer of the bank, there may be some form of discrepancies that may arise between the bank statement balance and that of the cash book balance, and that's where the bank reconciliation statement comes in to solve that problem. And we are saying that if that happens, what are some of the hidden factors, what are some of the factors that accounted for the reasons why the bank statement balance may not be in agreement with that of the cash book balance? That's what we are going to look out for in this video. So just pay attention, be with us, and just relax yourself so that you can easily get the reasons why bank statement balance may disagree with the cash book balance. So now these are the factors that account for the discrepancies or the differences in the cash book balance and then the bank statement balance. So let's get onto it. Now we have three forms or as a factor that may account for the difference in the bank statement balance and then the cash book balance. First one, we call it the unrecorded items. The unrecorded items. Then the second one, we call it the omissions. Then last one, we call it what? Specific errors. And this is what we are saying. We are saying that generally all the discrepancies, all the difference that may arise in the cash book balance and the bank statement balance are basically what? Errors. We are saying that basically these three, the unrecorded items, the omissions, and specific errors, they are all what? Generally errors. But we are able to classify these errors into subgroups, where we have one called the unrecorded items, and we have one called the omissions, and we have the other one called what? The specific errors. So this is what we are saying with the unrecorded item. All that you need to bear in mind here, that first thing you need to get it here right here, that the unrecorded items is an error of the bank. It's an error that is made by the bank by them failing not to record what? Those items. So take note, unrecorded items are items that the bank failed not to record. That's what I mean by the unrecorded items. Then omissions is also an error that the customer or the current account holder of the bank also fails not to also to record. So it becomes an error to the customer. And then the specific errors is attributable to both. It can either be committed by the bank or it can be committed by the current account holder or the customer of what? The bank. So let's note this. First, we are saying unrecorded items are an error that is made by what? The bank, by them failing not to record it. Okay. Then the omissions too is also an error by the customer or the current account holder not failing also to record in his what? Book. Then the specific errors, we are saying that these errors can be committed by both the bank and at the same time can be committed by the customer of the bank. And what are the meanings or the ideas behind these items that we are actually talking about as what? A general what? Errors. As a general what? Errors. So let's go into deeply to explain the reasons why we are saying these are errors that may cause what? Differences in the cash book balance and bank statement balance. So now we are taking the unrecorded what? Items. We are saying that under the unrecorded item we have two items. We have one the unpresented checks. Unpresented checks, can also call it unpresented checks, can also call it the uncleared checks. Uncleared checks can also call it what we call payment per its nature and how it functions. You can say it's payment or checks. Payment checks. Okay, then you also have, and the same uncredited item, you also have what we call the uncredited or lodgement, or you can call it what? Deposit. They all mean the same thing, deposit or checks. And this is what I mean by the unrecorded what items. We have two: unpresented checks and uncredited checks, or their other alternative names that we have for it. So now let's get into it. What is unpresented checks? We are saying that it's basically a checks that. So what are we saying about the unpresented checks? We are saying that these are checks that the entity, right, may issue to its suppliers. Okay, we are saying that the unpresented checks are checks that the entity or the business may issue to its suppliers, but for which the supplier or that creditor may fail not to present to the bank for what? Making payment. That's why we call it what? Unpresented checks. So if the customer or the supplier has presented, then you should have called it what? Presented checks. But here the supplier failed not to present the check to the bank for what? Payment, or for the business to be what? Cleared. That's why we call it uncleared checks or payment or checks. So we are saying that unpresented checks are checks that is issued by the entity or the firm, here the customer, in case he is the firm, to it was suppliers or creditors, or to it was those that he owes him or her, those that he owes them, right? He present those checks, he issued those checks to them, but they may fail not to what? Present such checks to the bank for payment to be what? To be done. And when it happens like that, we call it what? The unpresented check. So when it happens like that, anytime presented check comes in, we are saying it's an unrecorded item. Why? Because that the business or the customer may issue that check. Once it's issuing, meaning that check is going out, money is going out, so his account in the bank column of the cash book going to be what? Credited. It's going to be what? Credited. Going to be credited by convention, going to be what? Credited. So the cash book and the bank column going to be what? Credited. But instead of a supplier to present that check to the bank for payment to be done, he may fail not to present that check as at that time where the bank statement would have been received by what? The customer. Okay, so when it happens like that, there will be a difference because unpresented checks wasn't cleared, and so therefore it wasn't recorded on the bank statement where entries has been made at the credit side of what? The bank column of the cash book by the entity or the customer. So always unpresented checks are found at the credit side of what? The bank column of the cash book. Let's take note of that. So that is unpresented checks. Then uncredited checks is the opposite of the unpresented check. Uncredited checks is like we are making what? Deposit, right? Or lodgement. Okay, so now here is a check that is issued. Either it is issued by the customer or a debtor to the customer. Be with me. It is a check that is issued, okay? It is a check that is issued by, let's say, a debtor of a firm to the firm, right? And the firm accepted that check and make what? Payments into its books. Because once the check comes in, we expect that we send it to the bank and what? Cash it, whether we are to deposit, and most of the time the firm will deposit it, okay? And once we send that check to the bank may at a point in time may not what? Record that what? Check to be credited to our account, okay? So anytime we receive a check and we send that check to the bank, but the bank failed not to record that check as a means of deposit right, that we have sent to them, it becomes what we call the uncredited checks. So you are saying the uncredited, these are checks received by a business and debited in the cash book and then sent to the bank for lodgement, but not credited by the bank. So that is what we mean by uncredited checks. We may receive that check from either our debtor or a customer, and we may debit it in our cash book. That's the bank column cash book, the bank column of the cash book. But later on we send to the bank, but the bank may fail not to record it after we sending them. And when the bank statement arrives, you may see that the bank failed not to record. It may be due to a lot of reasons. That's why we are saying that all the unrecorded items, which are the unpresented and uncredited, are errors made by the bank. So as at that time, the bank hasn't credited our account, and when the bank statement arrives, we may not see the reflection of these or uncredited or the lodgement check. And we are saying that when it happens like that in our cash book, since we debited it, we are saying that all uncredited checks or lodgement checks or deposit checks are found at the debit side of the bank column of the cash book. So anytime you bring a bank statement, you want to know uncredited checks, they are always found at the debit side of the cash book. That's the bank column of the cash book. Because once we receive it and we send to the bank actually did not credited us. So it was, as at the time the bank statement was sent, it wasn't recorded, so it cannot be found, and so therefore it becomes an error that the bank has made, and we call that the unrecorded items, and we call it the uncredited checks. So let's take note of that. So these are the two, the unrecorded items. We have the unpresented and then the uncredited. So if you have any question, kindly comment below so that I can assist you on that with this aspect. Let's move on to the omissions. So under the omissions too, we have these items. Generally, omissions, there are many, but these items are commonly found in every bank reconciliation statement that a customer may actually want to prepare. And these items, we are saying that these items are errors that are committed by the customer of the bank. As at the time the bank statement may be received, the customer may not aware or may not be aware of these items, but these items may be found on the bank statement. But as at the time it will be received, he may not be aware of these items, and so therefore, when the bank statement is received, there will be a discrepancy in terms of the balance and that of the cash book that the customer keeps. Okay, so these are the items I'm going to look out for under the omissions. So under the omissions, you are saying that it's not recorded. It doesn't mean recorded. Omissions mean the item has not been recorded. So here the item has not been recorded by the customer. Okay, so under that we are looking at, first one, you're looking at standing order. We are saying that standing order is basically a written instruction. Take note, is a written instruction. We are saying it's a written instruction. A written, don't mind the spelling, but let's listen to it. We are saying that standing order is a written instruction, right? That is given by the customer or the current account holder to the bank to make certain payments or to make specific payments on the customer's behalf. So now let's say, for example, that let's say the customer might say that, okay, for every 2 weeks, I'm expecting that the bank, you must make let's say 50 or let's say 500 Ghana cedis to an orphanage, right? Or to an orphanage home, to an orphanage home. And every week the bank will make that payment on behalf of the customer. That is an instruction that the bank has the customer has given to the bank to make. So when it happens like that, every week or every 2 weeks, the bank will be making that payment on behalf of the customer to the orphanage home or to the orphanage. All right. So at a point in time, the customer may forget that he has instructed the bank to make always 500 Ghana cedis payment to the orphanage. And when the bank statement is received by the customer, he may not be aware, might have forgotten that he has given that written order. So later on, once he be going through, the bank statement might see that, okay, I told the bank that he should make certain payments on my behalf. Okay, now I've recognized that. Once able to recognize it, you will see that, okay, that was the reason why what I had in my cash book balance as the bank column balance didn't agree because of a standing order. because of the written instruction that I gave to the bank to make certain payments on my behalf, that is the customer's behalf. So that is standing order. Now, dividend receive. We are saying that dividend receive is a form of what? An interest, or a form of a dividend that is received by the customer, right, on the basis of certain investment that he has what? Engaging. Or it can be any business that you have engaged upon which has received what? A profit or income on it. And so therefore, it will be paid directly to the customer's account. But as at the time the statement may be received by the customer, he may not be aware that dividends has been received on the investment that he was making or the business activity that he actually joined. Okay, so you're saying that dividends received is basically a form of what? Income that is paid directly to the customer's account, unknowing to the firm or knowing to the customer, but the bank will receive it and may be credited to the customer's account. But as at the time the statement will be sent to you, is not aware, and so therefore there will be that discrepancy, unless after receiving a check, going to see that okay, I had a dividend that was paid directly into my account, then I can finally see that when I prepare my bank statement, I need to get this kind of figure as the balance. So that is dividend received. Then credit transfer. Credit transfer, I think a credit transfer is basically, it can be in the form of what? An owings by the debtors, what? By the customer's debtors. Let's say there was a sales on credit that was made to the customer's debtors, but instead of the customer to make payment to that of the debtor make payment to the firm or the customer, he fails not to make that payment, but he made it directly to the firm's what? Account or bank account. So when it happens like that, the firm may not be aware of the credit transfer until the bank statement received. That's where he may see the credit transfer. So as at that time, he may not get the opportunity to record this credit transfer as a debit item in his what? Bank column of the cash book, and so doing, he may not record it. Okay, and the debit transfer too can be in a form of what? As you said, it can be in a form of these standing orders. That is a written instruction that you actually give to the bank to make. So anytime there is a debit transfer, it can be in a form of what? A standing order. So once you are making payment, meaning that you are trying to reducing your credit balance on the bank, on your bank, because anytime there is an increase in one's bank account, there is what? A credit. But anytime there is a decrease, the bank would debit the customer's account with the bank. You should debit it so that it will reduce. So when there is a debit transfer, it can be in a form of a standing order where the payment was made on behalf of the customer. You will debit the customer's account so that it can reduce its balance to get the amount that is actually standing in its account. So that is a debit transfer. Then a dishonored checks. A dishonored check, we are saying that is a checks that the customer may send to the bank, but the bank may write on it RD, return to, meaning that return to what? The drawer, meaning we cannot make such payments to the customer, or payment cannot be made. The bank has refused not to make payment with such checks. It can be due to a lot of reasons. It can be due to that maybe there is insufficient fund in that account, or maybe due to that maybe the amount in words is different from an amount in figures, or it can maybe due to that there is an insanity of what? The drawer who is likely to make what? The withdraw that money, or it can be that the check is what? A stale check. A stale check can be a stale or what? A dark check. A dark check. That check that is more than 6 months, the bank may refuse not to make what? Payment to that. So these are some of the reasons that may account for a dishonored check. We call it a bounce check that has been bounced back by the bank, and they may write on it RD, meaning return to the drawer. As at the time that the bank statement may send to, the customer may not be aware of what this is on the check until it is sent. Then he may be aware, then he may record it on, because you know that anytime a check received, we debit our bank column, then we credit that customer. But when we send the check, then the bank say that he can't make that payment, meaning that we need to come back and what? Cancel off what? That check by crediting what? Our cash book. So when we are making adjustments, we will credit what? The cash book to cancel off that dishonored check that we record at the debit side. Then we debit the customer account also to cancel off, so that we record actual amount the customer owes us. Okay. when you get to the question part, you understand what I'm saying much more better. You'll appreciate it more. So let's take note of that. Then here we call the bank charges or the interest. As when we were discussing the current account, we said that the bank, the current account is such a way that it operates in a way where the customer may always be engaging the deposit and withdrawal of money at any particular point in time. So most of the time we call the current account or the demand account, because as when the money is depositing and withdrawal is always on what from current basis, that's on periodic. Always the bank is on hot. Sorry, the account is very hot, and always there is a demand of either there is demand of what money or withdrawal of what money. So when it happens like that, since the bank is running that form of services to the customer, the bank may charges what that customer an interest, and that interest can be in the form of bank charges. The bank charges can take in the form of what the checkbook that are going to be given to you, the checkbook that the bank will be giving to the customer, the checkbook that the bank will be giving to the checkbook, okay, or can be on commission on what turnover, that's the interest that they're going to charge as a commission, okay, and other interest that they will be charged to you, the customer, for them rendering that services to you. And as at the time these items will be known to the customer, he may not be aware of these items, and these items will be found in the bank statement, but the customer may not get opportunity to record it because he may not be aware that these items has been charged against the customer, and so therefore his debit side of the bank statement was debited, and that was reducing his credit balance on the bank statement. So that is the bank charges. It may be in the form of a checkbook, maybe in the form of a commission on turnover, maybe in the form of other interest that may be charged to, or other expenses that may be charged to the customer unknowing until the bank statement is received. All right, so that is the omissions aspect that we actually want to understand. Then lastly, we're looking at the specific errors. Basically, the specific errors are we have the casting errors, then we have what we call reposition of figures, as amount. Then it can be either a wrong debit or wrong credit of entry, right? So these are the errors that we said that with these errors it can either committed by both the customer or the bank. So casting errors will mean whether the figure is overcast or undercast, whether it's made by the customer, where instead of he recorded the actual amount, he actually overcast it, he increase the amount that you should have recorded it. But instead of, that's the overcast statement or the overcast or overstatement, but instead of he record the actual amount, he actually recorded the amount that is lesser than what you should expect to record, becomes what, an undercast or an understatement. That's also what I mean by the understatement error. And the two will give out the casting errors. And reposition of figures to has to do with where we try to change the position of the figures, okay? Instead of, let's say 2 1 2, we actually wrote 2 2 1. So we have changed the position of 1, and you see what is happening here. So that's what I mean by reposition of figures. And the wrong debit or the wrong credit is also another error that either both the bank or the customer may commit. Instead of them recording the item at the debit side, they actually recorded it at the credit side, and can be the vice versa. Instead of them recording it at the credit side, they actually record at the debit side. And when it happens like that, they all have an implication on the balances that will exist on the bank statement balance and the cash book balance. So this is where we bring an end to the part 2 or the lesson 2 of the bank reconciliation statement. So in the next session, we will be treating what we call the pro forma for preparation of bank reconciliation statement, and reasons why we need to prepare bank reconciliation statement, and an item of bank overdraft, and how we can treat most of the errors, general errors that we have discussed so far on the bank statement, on the bank reconciliation statement, so that we can bring an agreement between the bank statement and that of the cash book balance, and even dive deep to treat about how wrong debit and wrong credit also affect the preparation of bank reconciliation statement. So stay tuned with us. Thank you once again for watching. Stay tuned with us as we come your way with the next video on the preparation of the bank reconciliation statement and other aspects, and we tackle most of the questions. So thank you once again for watching this video. If this video was helpful to you, please consider by subscribing, liking, and sharing, so that we can reach as many students as possible who may be interested in these kind of videos, to help them to pass the examination and to pass it very well. So I'll come your way with the next video where we discuss the preparation of bank reconciliation statement. Thank you.